geothermal webinar series. This webinar series is a partnership between ThinkJ Energy and Enerchange, and once again, I am Carlo Cariaga, Editor-in-Chief of ThinkJ Energy. Today we have a very interesting session. Most of our webinars deal with technical topics, but today we're tackling more of the commercial and financial side of geothermal. We have the honor of hosting Migara Jayawardena of AMALA Clean Energy Advisors for a webinar on doing a techno-financial analysis of geothermal projects, allowing for more risk-informed decisions on investing in geothermal. Migara is the Managing Director of AMALA Clean Energy Advisors. This is a global consultancy specializing in helping clients navigate clean energy transition and sustainable development efforts. He leads AMALA's multidisciplinary group of global experts in helping clients formulate investment and policy solutions to decarbonize energy systems. Prior to managing AMALA, Migara worked at the World Bank Group for over 2 decades, leading efforts to help clients reform and develop energy and infrastructure sectors. He holds a Bachelor of Science in Economics from the Towson University in the US, and also a Master's in Public Policy and a Certificate in Public-Private Partnerships in Infrastructure from the Harvard University. Before I hand over the floor to Migara, for the audience, if you have any questions, feel free to type them in on the questions tab in the webinar panel, and we will get to those questions after the presentation. And with that, Migara, the floor is yours.
Okay, thank you very much, Carlo, and thanks to ThinkGeo Energy. It's a pleasure to be here, and thank you to everybody in attending this workshop. As Carlo mentioned, the topic we wanted to cover, and from what I understand, a lot of the audience is much more from the technical side of geothermal, and I think it won't be a surprise to you that there's a lot of inherent risks associated with developing geothermal. And from when we put a finance lens, which is what we're going to try to do today, that a lot of the financial performance and impacts are actually quite driven by the technical and resource-related risks in geothermal. So when we look at a lot of these investments, we really bring these two together because they are not things you can completely separate out when you're trying to make investment decisions. You have to make sure that the resources are technically viable and manageable. At the same time, you have to make sure that all of those things translate to a robust financial project. With that in mind, I want to just also mention my colleagues, Paolo Bona, who's a geothermal resource specialist, and Devanshi Patnaik, who is a finance specialist. They're joining us, a couple of resource people may jump into the Q&A section. But with that in mind, let me get started. And I'm gonna just turn off my camera quickly. So, okay. Now, I think most of you might have seen this graph before, or you very well know that one of the biggest challenges of developing geothermal is you got to navigate this multi-stage development process, which has its ebbs and flows and a bunch of decisions along the way. And this was something we developed at ESMAP at the World Bank, which has been used widely. And, you know, essentially, you are starting off at this stage where you are really trying to explore, and this is a very high-risk stage, as we can see, but it's not that you need a lot of money, it's just that you're putting money that you don't know whether you have a resource that is viable or not, which is why the risk is very high, although the amount of money may not be significant compared to the overall project. At some point, you're going to make a pre-feasibility assessment, and then you have a go, no-go decision based on what you found up to that point. It doesn't give you investment level certainty, but it gives you more knowledge than when you started out. After that, you may do some confirmation drilling and then get to a feasibility stage. And again, you're faced with a big investment decision that you have to bring in the technical and the financial to answer, what do we go forward or not? And at that point, if you think the project is investment ready, then of course you would move forward with production drilling. At the end of it, depending on how it turns out, you may or may not rescope the project, although it's very unlikely you would completely turn back at that point. And then you proceed with building the power plant, where the risk is significantly lower, but usually you need a lot more financing at that point, depending on the size of your power plant. So, you know, we want to keep this frame of risks versus costs in mind. Risk coming from the technical side, the cost and the financing coming from the financial side, and they really do need to meet at some point to make what we call a well-informed decision. So if we keep that framework in mind, let's look and see what an investment might look like. What kind of investments would we need to make? And this is just an illustrative example of a 40 megawatt geothermal power plant with a bunch of assumptions. So first, what are the capital expenditures that you need? Well, when you're starting out, the surface assessments, perhaps $1 or $2 million. We're saying $2 million here. Then after that, you have some test drilling and the pre-feasibility we just talked about. Let's say that's about 10 million. And then you have confirmation drilling and you get to a feasibility. And this is one of your big decision points, because at this point, you have a good sense of what your resource capacity of that geothermal field might be. Now, if the decision is to proceed, you know, then you're going into not a no risk stage, but definitely a lower risk stage, because now you're going to try to develop out the steam field. Okay, so here we say, okay, we have $40 million we allocate for the production drilling to develop the steam field, and after that you have your above ground infrastructure, the steam gathering system and the power plant. And we're saying it's $90 million. And again, it shows now we're at the lower risk stage, but the financing numbers, the money that you need is much larger, right? At the end of that, you could commission your power plant, and then you have some operational costs. And here we're saying it's about $5 million a year, gives you a, you know, in geothermal, where most of the costs are investment costs up front, so the operational costs tend to be somewhat low, and that is a cost profile of a geothermal. Now, of course, each project would be different, but for this particular example, this is a cost profile for a geothermal project. What about the revenues? Well, we're going to make it simple and say the cash flows we get from selling the electricity that is produced, and here we say it's $46 million a year. And again, keep in mind, at this point, we're going out 20 plus years, both operational and the revenue stream, okay? Now, the question is, how do we know whether this investment is worthwhile or not? These investments we have to make, these cost figures, the financing we're looking at, does it make sense? Well, can we take the benefits? That's the $46 million you're going to get each year. And can we take out all the investment costs and the operational costs? And would that tell us whether this project is worth doing or not? Can we make that investment decision? Not quite, right? So we definitely do want to recover these investment costs. That's a fact. But the challenge is that these investments don't all come at one time. They come over time. And when I tie up some money, when I invest in this project, let's say we're at this early stage and we invest this 12 million. Well, that's 12 million I don't have to invest in something else, right? And that means there's some other investment I could have made and made money on that I have to forego. So there is a cost to the timing of these investments. So when we talk about recovering costs, we do want to recover the investments we make, but we want to recover that plus something else that we would have made in some other investment. So it's that time value of money that we have to think about, especially when it comes to geothermal and the risks that are associated. So let's take a look at that in a little bit more detail, right? So I have this is a hurdle, and I'm saying that at each of these stages, you have to jump over not just the cost recovery, but you have to actually make up that alternative investment opportunity that you gave up in order to invest in geothermal. The reason I use a hurdle is we often call it a hurdle rate in finance, but otherwise it's called a discount rate, which allows us to factor in the impact of these investments over time, right? So at each of these stages, you're going to have different amounts that you have to hurdle and make up in order to make this investment worthwhile. So this becomes a very important concept. There's a lot of technical aspects I could explain to you on this, but I think it's just to remember that just recovering costs alone isn't enough. We have to recover something more. And the question is, how much more? Okay, so the way we can look at it, and let's just focus in on the high risk exploration stage, right? So earlier we had $42 million allocated in our cost profile, right? So then the question is, what kind of return do I want to get on this $42 million investment? Okay, well, first of all, there is whatever the alternative I could have invested in. So let's say that's 8% doing some other project, okay? So that means I have to recover 42 and 8% on top of it in order for me to feel this is a worthwhile investment, right? But remember that you're at a very high risk stage in the geothermal project. That means that you could possibly make this $42 million investment and then find out that this is not a viable project and you could lose that money. So that means you see that there's a lot of risk for which you're going to want a risk premium, right? So here we're going to say the risk premium is 12%. That means the overall hurdle rate that you need to jump over is 20% at this level. Now, whether it's 8 or 12, that could depend on the type of investments and the type of investor, right? But just as an illustrative example, that you have your alternative plus your risk premium, and that's what makes up this hurdle rate at this high risk stage. Then let's go into the production drilling, right? Now that we're developing the steam field and the risk is not negligible, but it is significantly lower. And we had allocated $20 million for that stage, right? So we still have the 8% that I would forego. So if I took that 40 million and put it somewhere else, I could get every year, I could get an 8% return. So I need to make sure that the geothermal project is giving me at least 8% or more. But now I have a different risk premium and I'm going to call it 7%. Why? Because the 40 million I'm putting in doesn't face the same level of risk that you did when you're at exploration. You have confirmed your resources. You have a much better idea about the viability of this project. By this point, you probably confirmed the commercial viability of this project. So your risk premium is lower. That doesn't mean you cannot get a dry hole when you're drilling. So there is still some risk, which is why the risk level still stays at some level. Then if we get to the next level, now the financing amount goes up. Now we're investing 90 million in the above ground infrastructure. And here we still have the same 8%, but we're going to add a 2% risk premium because for the most part now you're doing a power project. You're not, your steam resources are well developed. You have a lot of confidence at this stage, right? So it's a much lower risk premium. So what is the hurdle rate for this project? And this is one of the challenges of geothermal because your risk profile changes as you advance through this multi-stage development process. Well, I have this on the right-hand side. So I'm taking the different investments. This is your exploration, this is your production, and this is your above ground infrastructure investments, and I'm giving it a weight for each of them, okay? And that's just the percentage of the total investments that it makes up. Then we're going to take each of the discount rates, right? These hurdle rates that we had. So we had a 20% for the exploration. We had a 15% for the production drilling, and we had 10% for the above ground infrastructure. So if I take the investment weights of each one, those percentages, times the discount rate, and add them up, what I get is a 14% discount rate. Okay, in other words, if I can hurdle 14% over this project on a weighted basis, that means this project would be viable or worthwhile from a financial point of view for me to go and invest in. Okay, now let's see how this plays out if you applied it to that investment we were just looking at. Okay, so now I'm going to show you some cash flows. So this is exactly the cash flows from those investments that we had. So the total capital expenditure is $175 million, right? So this is it's starting out with your surface studies, then you have your test drilling, you have your exploration, production drilling, and this is your above ground infrastructure. Okay, so that is an investment cost profile. And then we have the net revenues, and you can see that is the cash revenues from sales minus the operational costs, right? So, and these go on for, in this particular example, I have it going on for 25 years. And those investments, if I bring it to the present value, in other words, discounted using that hurdle rate, and plus I also take this 172 million in capital expenditure and bring it to the present. And if that turns out to then be positive or viable, then that would be a worthwhile investment to go through, right? So in other words, the risk profile based on the resource risk you put in is a big determinant of your discount rate or your hurdle rate. And as a result, it is a big determinant of your financial decision. So let's look at this. So we said the net present value, that is if I take all of those cash flows that you see here and bring it to one point in time, right? Using those discount rates. Again, I'm skipping the formulas for you, but what it's telling me is that I can make $23 million in addition to my 14% return, okay? So it's 23% above my hurdle rate, right? And the rule on a net present value is very simple. If it is above zero, that means I am making my return on the hurdle rate and the project can move forward. If it is negative, then you're not covering your hurdle rate and you should. Okay, so this is when you're using the 14%, that weighted discount rate that I use. But suppose we didn't do that. Suppose we use a 10%, just treat it like a standard power project, right? Then at 10%, it would tell you that your net present value, meaning above 10%, I would make $82 million. Now that's actually much more promising than $23 million, but the problem is it overinflates your return. And if it's overinflated, it doesn't fully account for these resource-related risks. And if you go in thinking that you're going to make 82 million and this is a great project, you might be very surprised when it comes out more towards the 23 million. So you don't want to underestimate the risks and use a lower discount rate. At the same time, you don't want to overestimate the risks either. So if we used a 20%, which is the exploration level risks we were using, and assume that, oh, well, we need a 20% return for the entire project, then we would be overestimating the risks here, and we would be overestimating the risks here. And then what would you have? You would actually have a negative project, and you wouldn't go forward with it, when a more accurate estimate of the risks means it is a project that is worth going forward with. So the thing I want to emphasize here is that this relationship between your resource risks or technical risks, however you want to call them, and the financial performance is integral in a geothermal project when you're trying to make an investment decision. Okay. Let me move forward with another example. So this is looking at an entire development process, but I want to give you an example of a project we looked at in Indonesia. There's actually 2 geothermal fields. Now, this is an investment level analysis, and I want to show you another way. So we just looked at how we can use discount rates to factor in and consider the resource-related risk. I want to show you another way of doing it where we can use more stochastic simulations, Monte Carlo simulations, to get a better sense of how the risks are. So this project, it was in Indonesia. It was 2 geothermal fields totaling about 150 megawatts of installed capacity. The overall goal was they were trying to kickstart a 1,000 megawatt expansion as a way of replacing and displacing baseload coal-fired power. So it had a strong environmental angle to it. The work we were doing would really doing investment level due diligence for a $300 million financing package. And the analysis that I want to show you is how the financial performance, how can you make sure that your finances are good enough to withstand the resource-related and technical risks that you have with geothermal. So let me just give you this example very quickly. So in this project, we actually, we started out looking at the project. The developer was looking for a rate of equity of 20% across the board. Okay, and that was because they had alternative options, particularly in the oil and gas sector. So they actually could get pretty high returns. Now, they had other reasons why they wanted to also invest in geothermal, but it's sort of an extreme position, but they started out with that. The power off-taker in Indonesia, they wanted to pay a tariff that was essentially what they were paying for coal on a financial basis. So it wasn't accounting for many of the other benefits that geothermal was going to be. So ultimately, what that means is this project at this extreme level, just to give you as a reference, wasn't particularly viable, right? Because you have a net present value that's quite low. And the work that we did was really trying to see if we can develop a structure project in a way that it could be financially viable. So first of all, you had the government here, the developer, and the off-taker working together because it was a national program. So the project sponsor, the developer, opted to lower their return on equity from 20% to 14%, which made up some of that difference. Then there was a power purchase agreement that was negotiated, facilitated by the government, that provided a much higher price than the coal-based tariff, which bridged some of the gap. And then there was some concessional financing and from the World Bank and the Clean Technology Fund, one of the climate funds. And because of the concessional nature of it, it was able to bridge. So it was one of those things where when the whole financing package and other factors were brought in, then you had a project that had a positive 51 million net present value. So in this case, as a static investment decision, you can say, well, that's positive. It can hurdle my return, in this case, of 14%. Therefore, it could go forward. There were 2 questions that came up. The first one was, well, if we're using concessional financing, why do you want to provide a scenario where they can be more profit than needed? Could you not shift it to other investments and help develop even more geothermal? The second question was, well, that 51 million sounds great because that is, by the definition of how a net present value works, you want to move forward. But can it really withstand the risks that are associated with this project, right? So let's ask that question now. So first, I want to show you some risk variables that we looked at. Okay, so what we ended up doing, and I know this audience probably is familiar with Monte Carlo risk analysis, right? Because most of the time, when many of you are looking at heat resources and trying to develop a geothermal resource capacity, you usually estimate them in probabilities. There's a 90% chance you could have this many megawatts. You have a 50% chance you could have a certain amount of megawatts. And you're mostly using a risk analysis approach using Monte Carlo. Well, that can be applied all the way to financial decisions. And that's basically what we're doing. But we're using, again, some technical parameters that are driving the finances. So let me just quickly explain these to you. The first one is the well productivity itself. For each of the fields, we had, for one of the fields, we had actual drilling information, and that allowed us to use some of that information to try to create a distribution. What's the likelihood of success, and what kind of average well productive capacity would we get? There was one other field that had less drilling, but we had actually the luxury, I would say. We had the data for about 200 wells that were drilled all across Indonesia. So now you have to be very careful because these are very field specific when you're using a general number, but we felt the amount of information was robust enough, and so we factored that in. And what we wanted to see was what happens if the well productivity doesn't turn out the way that we predict, okay? And then what would the impact on the financials be? The second one was on the power plant side. If you look at the latest IRENA report, it talks about plant factors in geothermal as a baseload technology as high as 0.88%. But in this case, in Indonesia, the projects were operating at very, very high percentages. Sometimes you had power plants that were operating almost at 100% plant factor. So we used a 92% plant factor, but because the plant factor was high, we wanted to make sure that if it didn't turn out that way, if the actual plant factor in these projects came out lower, could the project withstand these changes, and or how bad would the financial performance suffer? Then I want to highlight the third one here, which is in one of the fields, we only had a 90% confidence based on the technical resource estimates. We only had a 90% confidence of about half the resource capacity of the 110 megawatts. We only had a 50% confidence about the 110 megawatts, which means you could, in theory, run out of steam by the time before you finish your 25-30 year life cycle of the project. So we modeled that and we included that as a probability. In other words, the risk analysis would create different scenarios that would shorten the life of the project or lengthen the life of the project, and it would have a financial impact. So these are the three risk variables we looked at, and then what we did was we ran 1,000 different scenarios using these risk variables for the project. So instead of looking at one net present value, the 51 million you saw earlier, we looked at 1,000 different net present values and started to see, well, what would happen if these variables were to change, okay? So let me quickly summarize some of the results there. First of all, the first two scenarios that you see, these are those extreme positions, and I don't think it would surprise you. So what the question we asked is, out of the 1,000 scenarios we're simulating, how many of them were negative and how many of them were positive net present value? If they're negative, then that's not good. If they're positive, that's good. So in this case, you can see that in those extreme scenarios, that there's very little likelihood that these projects would be viable, okay? Then, if you recall, the scenario that we looked at was where we had the concessional financing package, right? And that's the one with the 51 million net present value. And so the 1,000 scenarios that were run for that particular scenario, what happens? the probability of a negative return drops to 23%. It's not zero. You cannot predict the future. Things could turn out not viable, but it became what is much more manageable risk profile because of the financing package that was put there. In other words, the financing that was available was robust enough to withstand some of these risks, right? And as importantly, we also looked at whether there's a probability of a high loss. In this case, we picked the number 50 million, and you can see that the probability of a high loss goes down to almost negligible levels, right? But then we asked the question, what if you were to lower that financial cushion, the 51 million, right? So even if it was 1 million, it's still a viable project in theory because it hurdles the discount rate that you have. Well, if you made the margin that small, what we found out was the probability of a negative return goes up to 67%. So in other words, your project, the robustness of the project is considerably undermined if you don't have the margin. Put it another way, if you have the margin, then your project is better able, i.e. more robust, to withstand the changes and the risks, the resource and technical risks that are there. So again, it helps you make a more informed decision about how you finance and make the investment decision. But what is driving it? It's the technical risk and the resource related risk. Okay. And let me just show you one other example, because, you know, when you have a lot of data, you know, sometimes it's I wouldn't say it's easy, but you can start to do these complex Monte Carlo simulations. We had information for 200 wells, we had data on plant factors, all of that. But what if you're looking at something where there isn't a lot of data, or you're at the very early stages of development? Well, that becomes much more of a challenge. So here I wanted to quickly show you an example from the Philippines where a sector-wide assessment was done. So it's a high-level assessment and it was a part of work we did jointly with Geothermal, who many of you I'm sure know, to develop a geothermal roadmap and a de-risking, resource de-risking facility. So in the process of doing that, we reviewed 30 geothermal fields. And what we wanted to figure out is what is the financial performance of this portfolio of 30 projects, 30 fields, on a risk-adjusted basis, right? So let me take you through a quick summary of that, and then we can close out. So I wanted to, again, this approach was developed by Geothermal at Schlumberger, and you can see that a whole slew of factors, technical factors were used, and all 30 of these projects were at the exploration stage, and that was one of the challenges. So in other words, there wasn't necessarily investment level confidence in the data, or the projects were not as advanced to be able to do the kind of simulations that we did in the earlier example in Indonesia. So the factors that were looked at is, one is, okay, at what stage of development, even within exploration, if you're just at the surface level, then it's a little bit different than if you actually drilled a well or two, the level of information you have. So that makes a difference in terms of the information. Now, again, you're looking at 30 fields, and they're not all apples and apples, and that's part of the challenge. You have apples and oranges. So they looked at the heat resources and the reservoir temperatures to figure out what the capacity of these projects might be, the well depth and cost and well productivity, figure out how much it may cost to develop the upstream, and then some of the well decline rates, because that would determine what kind of makeup drilling that you need to have. And then if there were any special challenges like scaling or corrosion that could affect your operations, and other issues like access and logistics. Now, to kind of equalize all of this, to be able to compare, our friends at Geothermex basically had to look at the quality of the data, not just based on the stage of exploration, but also the material that was developed for each of those fields. And you can see, where if the data was very minimal, you would have a different kind of risk adjustment than if you actually had done some drilling and you actually had not just inferred assessments of the resource, but some direct assessment of the resource. So it creates a risk profile. Let me give you a quick summary. Don't worry, this is just a big graph of everything, but I'll highlight a few things. And this is essentially showing the different financial returns based on those technical risks that I just mentioned. But first of all, you can see all these different fields. The different colors show how advanced the fields are. So a green would mean it is at a much more advanced level, although they are all within the exploration stage. A red would mean something less. Then it was determined what is the nominal capacity. In other words, before any risk adjustments, what kind of field capacity could be estimated at this early stage, right? But then using those factors I just showed you, a whole slew of structured adjustments were made to each of the fields, depending on the data that was available, how advanced things were, to come up with the risk-adjusted capacity, okay? And so that gives us a comparability. Now, a big caveat, this is not an investment level analysis, but it does allow for wider comparison and making investment decisions at a higher level, at a portfolio level. Let me just highlight two examples without getting into all the detail of this. So we take a look at this project, right? Take a look at project E and project U, okay? So you can see the nominal capacity of both of these projects are actually exactly the same, estimated to be 73 megawatts of capacity. But what you see is that once the risk adjustments are done, the risk-adjusted capacity at this point, right? Because it may change as you advance through that maze of development, the multi-stage process. But at this point is 29 megawatts, while the other one is 58 megawatts. And then look at the financial returns. Now, what we're looking at is the high end and the low end, okay? Because we don't have enough data and the projects are not advanced enough to do the kind of Monte Carlo where we can really look at the patterns. Instead, what we can do is say at the higher end, you could have a positive net present value of 91 million. But at the lower end, you could run a loss of 15, right? And then you compare that to the other field, and you can see a much wider range. So it could be, you could get a higher return, but you could also run a higher loss, right? And that is reflective of the uncertainty. You can see that it's a field that is less advanced and less clarity of information. Therefore, it has a much wider risk profile. So again, we're using a financial decision-making tool, but what's really driving that? It's all of those assessments our friends at Geothermex made, looking at the resource data, and then interface with us to look at the financial implications of it, or potential financial implications. Let me show you one more example from that. So if we take a look at these two fields, you can see that they're roughly around the same nominal capacity, but again, you can see that the risk-adjusted capacity is different. And in this case, this project, even at the lower end, is still a positive return, while this project crosses over and you could have a negative return as well as a positive return. So it kind of, again, gives you, even in a limited information case, you can have a structured way of connecting the technical to the financial and get some sense of a risk profile that you could use in your broader investment decision making. Again, I caveat, this is not a project level investment profile. Simply the data isn't robust enough to do that. Let me just close out before we go into the Q&A. Just so the kind of analysis that we do on the financial end, which is fed into with a lot of technical information you can gather by now, we call it, it's an integrated investment analysis because it allows us to look at it from multiple perspectives. What I showed you today is really a lot of technical information that are driving these risks and affecting the financial analysis. However, often when we're working with clients, we expand this analysis to also look at the economic impact of it, meaning beyond the project sponsor, beyond the developer, and that these days, especially with climate financing and a lot of international financial organizations involved, it becomes much more of a significant thing, ranging from the overall impact on an economy to the global impacts on climate change and other things. The other thing we also look at is looking at the stakeholders, who wins and who loses. As you know, developing these geothermal projects can be very beneficial, but you can have situations where people can feel that they're negatively affected and they can oppose. So this is a way of proactively identifying the beneficiaries and people who may be potentially impacted by this project, so that those issues can be addressed up front. I didn't cover these two because it wasn't the purpose of it, but when we usually do one of these analyses, we do an integrated multi-perspective analysis because it allows for better informed investment decisions. Let me stop here and turn it back to Carlo for any questions you may have. Thank you.
Okay, I'm back. Yeah, thank you, Migara. I found that the whole presentation very interesting, especially as someone who has worked in exploration. And for anyone in the audience who'd like to ask any questions, just feel free to send in your questions. There should be a questions tab somewhere on the panel. You just type in your questions and we'll get to them. But let's get the Q&A started with a few of my own questions. Before we go into the more technical aspects of geothermal and how that goes into the financial modeling, I'm curious how the non-technical factors go into that financial model, such as, say, there are a lot of governments going into creating legislation that hopefully benefits geothermal. And a lot of these have to do with, say, facilitating permitting, simplified permitting processes, or faster environmental reviews. How does that affect the financial model?
Okay. Well, thanks for that question. I would put it this way. I mean, when you're doing a lot of this quantifiable analysis, there's always it's never just quantifying everything, because there's a lot of qualitative analysis that goes in. So when you're ultimately structuring a project, you know, this whole process of getting approvals, permits, clearances, especially if you're importing a lot of equipment, those are pretty part and parcel. It gets looked at more from an implementation point of view than purely from a financial point of view. What's the financial impact you could have? Well, it's mostly in the timing, right? So, I mean, you know, before we started, Carlo and I were talking about how sometimes geothermal development can take some time, and that's true. But when you put in all these different ebbs and flows and challenges you could run into, it extends your time. Now, remember, when we talked about from a purely financial point of view, time is money. There's the time value of money. So when your project investment cycle starts to get expanded and expanded and expanded, and remember, usually you're not, unless you're doing a brownfield expansion, you're not making any money until you commission that project. So, you know, if you've only done your surface studies and it gets delayed, you know, you're not out too much money. But imagine you've done some exploration drilling and now you're stuck, whether it's a permit or even getting financing for the next stage. Now, you know, you've got $30–40 million tied up, and I can't do anything with it. You know, from a if you think of it from an economic or financial point of view, that has zero value until you start to produce electricity. So that's where the financing gets impacted. But I think the qualitative challenge of not just planning a project on a spreadsheet, but actually implementing is the other place where these kinds of challenges come in quite significantly, Carlo.
Okay then. So another question on the market side. In a lot of countries with mature geothermal sectors, they thrive on feed-in tariffs or PPAs, long-term PPAs. Is there a model where a geothermal project can develop in, say, in a with more volatile electricity rates?
Yeah, I mean, ultimately, the the reason you want a feed-in tariff, it could be one of a couple of reasons, right? The first one could be that geothermal on a financial basis is not competitive. And that was the case we faced in Indonesia, because the coal prices were cheaper on a financial basis, not necessarily if you factored in the environmental benefits and other things. But at the end of the day, the power company is saying, listen, I can get coal for price X, you want X plus, that's a problem for me, right? So when you have that, a feed-in tariff that has a premium can be useful. The other part of it, the reason you may want to have a feed-in tariff is the simplicity of it, right? So it's you have model contracts and offtake prices are set, so it takes out the negotiations out of the game. So there's an acceleration aspect of a feed-in tariff as well. So those are the reasons why you may want to do it. But ultimately, it comes down to how competitive geothermal may be vis-a-vis your other costs of electricity. And here we have to be also very careful to make sure that it is base load to base load, right? Because sometimes comparing a intermittent technology that gives very low technology prices is not it's comparing apples and oranges. But then we've been doing some work in some of the small Caribbean islands that are trying to develop geothermal. Their electricity prices, their generation costs could be high as 25, 30 US cents a kilowatt hour. So even though you're developing small scale, there's a real potential for geothermal to be viable. The challenges there are just getting past that exploration stage with modest capacity and things of that nature. So it's really it depends on where you're looking, what the market situation is, whether feed-in tariffs or some kind of structure is important, or whether it's competitive, but it has other barriers that's preventing it from moving forward. It's not a pricing issue.
Have you looked into geothermal projects that are being developed for power, but then there are also alternatives, such as say heating or direct use? Is it considered like is it an enabling factor for the project to be developed, or is this more of a competitor in say in getting investor attention?
Yeah, perhaps my colleague Paolo might have some inputs on this. From my point of view, I mean, there are countries, including places like France and where geothermal is used for heating and other direct use purposes. In many other countries, the primary driver is electricity. But there, I mean, if you look at, Kenya in Olkaria, Olkaria is mostly developed for power, but there's a lot of, if you want to call it side benefits, everything from greenhouses to other things that are being, done because of the steam. Or you can look at Iceland, where, you have the Blue Lagoon and other industries spawning around, but it's still centered around power. I don't know if Paolo has any thoughts on the direct use.
Um, yes, substantially that's the situation, Migara and Carlo. And as I know, obviously that there are possibility to improve the finance of a geothermal project through including direct uses in cascading beyond using for electricity. And recently also it came to the table also the possibility to extract minerals and so to have more money from the same operation. But it's we are still in a situation where you can probably do the exercise of putting everything together, but the projects are commonly started with just the electricity operation, and the cascading is something that is occurring successively if it's occurring. So we are still in this situation. I may think that probably in the future, when the industry can expand in a more complex way and secure possibilities of developing everything together may of course have an improvement in this sense.
Okay, thank you, Paolo. Um,
Welcome.
a common comment on the more successful geothermal development is that a lot of them are government funded. And now that we're kind of we want more private participation in the sector, and of course the risk appetite is very different. And so what do you think are the new financing mechanisms that are emerging for the geothermal sector? Like, are there like development funding, climate funds that are also getting into geothermal now? What are the trends that you're seeing?
Yeah, no, that's a good question. And again, I mean, it kind of brings to the forefront the challenges of the multi-stage development process. So I think if you look globally, and we have a report we did several years ago, again jointly with Geothermex, that looked around the world, and there's always been some public element in most of the developments. Now, that public element doesn't mean it's always developed completely by the public sector. There are many instances. Again, you can think about, ICE in Costa Rica or CFA in Mexico, which has been very much public state-owned enterprises developing the resources. But at the same time, you see a lot of approaches where the early risk capital, which is perhaps the most challenging, where there's a lot of cost-shared mechanisms, right? Some supports that the public sector provides. We broadly see two formats. One is the public sector kind of somewhat de-risks the project. In other words, develops that early part and then hands it off to a private sector, or treats it more as a financial transaction, gets a private developer, and then provides some financial incentive, i.e. risk capital, at the early stage. So it just reduces the private developer's exposure so they're able to take it. The challenge is at the very early stage, it is more challenging for the private sector to take some of these risks. And you asked about the climate funds, and the climate funds and the development institutions have stepped in quite a bit, at least in the developing world. Because I realize geothermal is not just about developing countries, but in the developing world, they have stepped in quite a bit and taken some of the risks. And there are, as a mechanism that you raised, we've developed quite a number of what they call contingent grants, right? So in other words, the private developer is getting some funding up front to be able to do the exploration drilling. And if it's successful, it converts into a loan and it gets repaid. But if it is not successful, then it's kind of forgiven, if you will, right? So in other words, the development partner or the climate funds are serving as a backstop on the risk to absorb some of that risk, not all of it, but some of that risk, so that private investors can move forward through that very challenging phase. And the hope is that after that, it could be a more smoother development process.
Yeah, and there's a question from the audience that I think we can expound on a bit further. They asked if you looked at any projects in South America, and of course I know that you've done a bit in the Caribbean. So maybe can you comment on like the market in South America, Central America, and what is it's kind of it's kind of been a slow region for geothermal. And so can you comment on that, and like what are the conditions that are needed to accelerate
Yeah.
the geothermal in this region?
Yeah, we worked quite a bit in Latin America, not just in the Caribbean, but Central and South. I'm going to say something very quickly and give it to Paolo because I think Paolo has worked in every single geothermal project in Latin America, honestly. So, broadly speaking, I mean, a lot of the development in Latin America has been in Central America and Mexico, right? Countries like Costa Rica, Nicaragua, they've developed geothermal. I think Honduras, El Salvador, and then Mexico with CFA has advanced a bit, and that there was more private participation. Market was opened up a few years ago, although it's been a bit of an evolving thing. In South America, it's been, there's been much interest in places like Chile, where I've worked, and many other countries on expanding the resource. So there's a lot of active work, but I think Paolo could probably give you a much better sense about, what is really happening on the ground, not just in terms of action, but results.
Yes, well, substantially, the current situation in Latin America, it has been somewhat stuck over the last few years, but some new things are rising recently. For example, in countries where, for example, like Ecuador or Bolivia, where the situation got up and down for a long time, seems now to be more decided to go ahead with geothermal, and in particular in Ecuador, there is a project that is called Chachimbiro that is currently in a tendering stage for installing an initial pilot plant. And in Bolivia, for example, there is also a tender ongoing for developing eventually the Laguna Colorada or Sol de Mañana field, which has been discovered a long time ago and remained there waiting for good opportunities to develop. And so this is what is happening in South America substantially. In Central America, at this point, there is a project in El Salvador, which is starting right now with financing from the World Bank, and this is Chinameca, a new field in El Salvador, so an expansion beyond the two existing fields of Ahuachapan and Berlin. And then there is a recently raised interest in Guatemala. Guatemala, they have two small fields, one in Sunil and the other one in Amatitlan. But now the government is interested to push forward exploration in other two fields that are known since long time. These are Moyuta and Tecuamburo, and so they are seeking for financing from the World Bank again to have support for this operation, in the sense that Migara said before. Just a minute, please. Where the public financing, or in this case, the IFI financing, is concentrating on the initial phase where the risks are higher. So to support the exploration drilling, thinking about the possibility that this can scale up the interest from private investor and go ahead with the development with a lower risk profile for the private entities.
And Carlo, if I may just quickly add on the Caribbean, it's been there's been the last 10, 15 years, a concerted effort with its own struggles to expand. And there has been some progress. A project in Dominica is under construction right now, and it's going to be commissioned either at the end of this year or the first quarter of next year, which would be the first new install capacity in the Caribbean in, I think, 25 or 30 years. And most of the OECS, the small Caribbean islands, are pushing because they have very high cost of electricity, so geothermal could be a very viable option. But again, getting through that exploration phase has turned out to be quite challenging, and the Inter-American Development Bank, Caribbean Development Bank, World Bank, the development partners, including the climate funds, again, have been playing a very active role. And at least for the Caribbean, it's been a bit of a game changer in terms of helping push some things forward.
Okay, then. So we're a little past the time, but maybe just one last question that is for me a bit more forward-looking. I'm sure you've probably heard of, say, the newer types of geothermal, like EGS or the advanced closed-loop geothermal. So obviously, this type of geothermal does not have the luxury of the hundreds of wells of conventional geothermal that have already been drilled. So can you comment on, say, the financial models of such types of geothermal and how can we better quantify like risk factors for this kind of geothermal?
Yeah, I think, again, let me have Paolo take some of it as well. But I think it's, when you get to the very experimental technologies, again, you can, on a spreadsheet, you can put numbers into anything. But the reality is that evaluating a commercially viable technology, a commercially proven technology, is quite different because you have a history, you have a track record, when you're getting into some of the experimental, and I'm not, discounting them at all. I mean, everything was experimental at some point. So this is kind of exactly the kind of forward-looking work that is needed. But the financing models are much more likely to be, again, experimental, venture capital, more technology-driven, rather than looking at it from an investment return profile. It's a high risk, high reward kind of thing. If one of these things, work out, it could turn out to be a good viable. And I think EGS is a very good example because I remember, a little while back, there was even a World Geothermal Congress that was combining New Zealand and Australia. New Zealand, be understandable given the geothermal that they have, but Australia, because at that time EGS was seen as a potentially breakthrough technology. But now you look at it over the years, and I'm not saying EGS is done, but what I'm saying is that that trajectory didn't quite pan out. But that doesn't mean EGS tomorrow or even another technology couldn't make that breakthrough. But all of these things have challenges, and the efficiency challenge in many of these, if you look at coal and other things, a lot of it has been raising the temperature to get efficiency out of it and make them more viable. The challenge with geothermal is, you can't, the temperature is the temperature. It's not that we can go and kind of drive that. I don't know, Paolo, if you have any thoughts on some of the emerging technologies.
No, I can just add that from my perspective, the difference in the technological approach is not changing the financial techniques in analysis of the project results of viability. The key thing that is changing is the risk premium that you should allocate in the initial phase, because that's the main difference in terms of technical and financial approach.
Okay, and with that, thank you, Migara and Paolo, for this very interesting and quite different webinar for our as part of our webinar series. And we look forward to hearing more, probably from AMALA, and you will probably get a bit more reports from you in the future, in the coming years, for sure.
Sounds very good. Our pleasure. Thank you for everybody.
Thank you everyone who came, and we'll have another webinar for you in 2 weeks. Have a happy weekend.
Okay.
Great. Thank you.